Hi. Hi.
Hi.
What's up, everybody?
2 weeks in a row. I'm kind of
I
like,
know.
why
This is
am
incredible.
I here?
I know.
Yeah, it's crazy.
Unbelievable.
It is.
I'm so happy to see you 2 weeks in a row.
You know, I think I'm happy to see you too.
It doesn't sound too promising.
So listen, I'm going to tell you a little bit about my morning because, my son, all you parents with the virtual kids going back to school.
Yeah, good luck. Have fun with that.
I will shop with you later. So my son has gone virtual.
Yep.
He's with us until the end of January.
Mm-hmm.
But this morning I got a message from their school district that the kids that were set to go back live, their school was canceled today because of all the rain. You know, I live in the backwoods.
It's true.
So all the streets were flooding out. So as I am trying to make myself gorgeous, because I have naturally curly hair.
I know that. They all know that.
I have naturally curly hair, and so I flat ironed it this morning and promptly walked out into the rain. So I am a frizzy mess, but I'm here for you, Rob Younce.
You look great.
That's right, thank you.
So, now that we have you here, what are we talking about today?
Okay, so we are not moving into, but over the years that I've been doing, I've been working in the credit repair space, I've found that a lot of my clients don't need just credit repair. They need to change their financial habits altogether so that they can be successful in our program and out of our program, and moving forward into the future, they'll know, do these things, not these things. And I got a really interesting question this morning. I have a gentleman who makes roughly $3,000 a month, but he's paying $1,300 to his rent every month. He's looking to move. He's going to be a homeowner with my help. He's going to be a homeowner. But he wanted to know what is the debt to income ratio on what he should be paying out versus what he's bringing in. He wanted to know specifically when it comes to his living accommodations, what he should be paying. And I thought that the number was right around 40%, but I think there's so many things that kind of go into that. So explain, please.
So, first of all, let's define what a debt to income ratio is. You take the entire amount of debts that show up on their credit reports. So, things that show up on credit report are not like any of utilities. So
you don't count those?
Don't count utilities. You'll count the housing payment.
Okay.
You'll count credit cards, any loans, any installment debts, and revolving debts that show up on the credit report. Okay. So you take that number and then you divide it by what their monthly income is, their gross income. So in that example, he makes $36,000 a year, so $3,000 a month.
He did that math quick.
Yeah.
I was like, 36, how'd you get 36? Okay.
So you take that number, whatever those debts are, divided by what the overall income is, the gross income, and that is the definition of your debt to income ratio. Okay? So each loan program is a little different. The one thing that is, one of many things that's great about the VA loan is that technically they don't have a debt to income ratio. So in the VA loan, what they look at is residual income. So we'll get into that a little bit later because that's a little bit more difficult because it does count, it looks at net income minus all the debts you pay, and that includes your utilities and things like that. So on the VA loan, everybody who has, every lender, every mortgage broker that has, they say that the debt to income ratio on a VA loan needs to be X or below. That's just a lender overlay. So the VA loan is great for that. The VA loan is kind of how mortgages were done in before the crash.
Horse and buggy days.
But you can make a lot of compensating factors to offset negative items that were on the credit report or whatever within that loan file. So VA, awesome, no debt to income ratio. When you get to an FHA loan, again, it's 3.5% down usually minimum. Typically, as high as you can go on that is really The general guideline says 45%. However, when you run it through automated underwriting, so that's another thing that we do. When we do pre-approvals, we run them through an automated underwriting given what they show on their pay stubs and what we see as far as their debts go.
Right, we talked about that last week.
Yeah,
what
right.
That was.
So
if you weren't watching last week, go back.
Go back and look. Because automated underwriting is hugely important because that tells us whether or not we can do the loan.
Right.
So even though the guideline may say 45 per the lender, so lenders may vary with regards to that. I've gotten approvals all the way up to 57%.
Okay.
58%. With COVID, that's kind of back down a little bit, so it's really the numbers around 50%.
Okay.
So if you make $3,000 a month, $1,500 in debts
Math
is
wasn't
where
so
we.
good right
Yeah, I
there.
know that was bad.
So no more than $1,500 should
Correct.
be going out.
Correct.
For
So-
certain loans. Now
for
you
certain
said that's an
loans, correct.
FHA.
Yeah, and then on conventional loans, again, it's whatever automated underwriting says because it does take into account things like the amount of money in reserves, meaning in your savings account. So in
Right.
case you have a rainy day, you can then have that money in reserve. So typically, if you have 6 months in reserves, meaning your payment is $1,500 a month, let's say. If you have $6,000, that's four months of reserves. So that will allow you a little bit more leniency than somebody who is going by paycheck to paycheck and just scraping by.
So I see. Okay, so I think we're on the same page there because that's something that I'm really trying to get across to some of my clients is, especially in the environment that we're in right now, where we all just got taken for a ride with COVID and all that stuff. So many people lost their primary employment and had no reserves, and then did have to apply for that forbearance, and we still don't know what the outcome of that forbearance is really going to be. We think they have it figured out, like it'll extend, but having a savings account, that rainy day fund, is super important.
Absolutely.
And if you need to adjust your budget and adjust some of the things that you're spending on to get you there, that's kind of a Dave Ramsey principle, but to get you there, that is key.
Absolutely.
And obviously for a loan officer, you need to have some money put aside for down payments, and you have to have money aside for residuals in some cases. So
the neat thing is I'm working with a young professional now, and we are looking at some down payment assistance grants and closing cost assistant grants, and he actually has some money, and we'll still be able to get those grants that are forgivable after a few years.
right.
But in certain cases, I know one of the last ones I did, they got $14,000.
My daughter got
As-
$15,000.
Right, out of a down payment assistance as well as closing cost assistance. So typically they apply that to the closing costs first, and then what's left over, they apply it towards down payment. Just allows them to buy more home.
Right.
With this gentleman, he has a little bit more in savings, so it's good. He has enough of a cushion, but for those types of programs, though, you can't have too much. You can have too much, but you don't qualify.
Right.
So, but he's still in a great position because even without the grant, he qualifies and can pay for it and things like that. But he's a first-time home buyer, so there is money available.
Right, that's so awesome. That's awesome. Yeah, so the debt to income ratio was the big question that I got this morning, and I think they kind of.
And I get that all the time. They want to know how it's calculated. People want to know exactly what it is. A lot of loan officers just refer to it as DTI, debt to income.
I say it a lot, and I'm not a loan officer.
Yeah, and I try not
That's
to.
what happens when you hang out with loan officers. You pick up their lingo.
No.
DTI. Let me ask you one more question as we're talking about DTI, debt to income ratio. Is now I know with some lenders, and I just want OEM's policy on it. With some lenders, people will have charge-offs. They'll have like repossessions and that kind of thing that they haven't paid off yet. But I know that with some companies that I've seen, if you can set up some sort of payment arrangement, so your credit score obviously hits the goal that it needs to be, which remember guys, credit score doesn't need to be super high to qualify for a mortgage. So a lot of people think it's got to be up in the 700s. It doesn't. It can be in the low 6s or semi-low 6s.
Right.
But with a charge-off like that, is that true that you can do a payment arrangement with them?
With certain
and
loan
still be
programs,
okay?
yeah, with certain loan programs, yes, you can.
Okay.
Without slicing and dicing each loan program up. Typically, FHA is because it only required 3.5% down, it's government insured, typically a little bit more lenient there. So yeah, they can count, I think I had a gentleman who was 9,200 or so, had a repossession, and they were able to work out a payment plan and counted that towards his debt ratio.
But you have to be paying on it for a certain period of time.
Correct.
It can't be, I called them, I made this payment plan next week,
And then
let's
we
close
never
tomorrow.
pay. Right.
Yeah. Okay, so we don't want to do that. And I'm a little different than a lot of credit repair companies, or again, like I said, I'm starting to move into a different realm simply because I have a different view of these
Right.
things, and I'm more on track with financial responsibility. I encourage a lot of my clients to take care of those, because what will happen, oftentimes what we see is, even if I'm able to take those kinds of things off of a credit report, not saying that I can, but if in the past I may have had success,
Right.
Oftentimes the creditor will come after that client in court.
Absolutely.
So just because it's off of the credit doesn't mean that you don't owe it anymore, so let's just hit it head on.
Absolutely.
We'll still work on seeing if we can get it removed, but the creditor's not going to come after you if you've already dealt with them, if
Correct.
you've already talked to them and made those arrangements.
Right.
But I did want to make sure, I wanted to make sure I had OVM's stance on that. So.
Yeah, each loan program's a little different.
Right.
And I guess that's a confusing thing for a lot of consumers, is that, each loan program has a different stance and a different policy on collections, judgments, charge-offs, bankruptcies, time waiting for bankruptcies, foreclosure, deed in lieu of foreclosure. I mean, there's a lot of moving parts to the mortgage, and that is, it's one thing that I try to educate all the way through,
Right.
so that people understand, why they can use this program or can't use this program,
Which I love.
because a lot of times it matters. I mean,
It
it
does.
really does. And I found that it sets the client at ease, because now they're a little educated and they know why we are going down a certain road. So when they talk to somebody at a cocktail party or a barbecue or whatever, and somebody's bragging that they got a really, really low rate, a lot of times the person thinks, well, I should get that rate because of this, but
Right.
there might be something that's kind of a wall put up why they can't get to that.
I tell people all the time, your credit report doesn't look like somebody else's credit report.
That's right.
It never does, but it's the same thing with your bank account. It doesn't look like everybody else's bank account. So the whole picture has to come together to line up with the loan. So yeah, I love that. I love that, and we are going to dig into, at some point, the loans.
That's
We're
fine.
gonna dig into them.
We can do that.
But I do also like the idea, and guys, back me up on this if you want to hear about them. I actually just learned some information about how to do a deed in lieu of foreclosure, and they are not. So it's funny when you people like to just throw terms out and make it sound like things are so easy, like, oh, but you could just, or you could just, or you could just. And there's a lot of those terms out there are not as easy as they seem.
No.
So I want to make sure that what we're trying to do is really educate consumers, and whether it's loans or it's credit or it's finances or whatever, we both dig into that in our careers. So we'll make sure that our consumers are really, really educated. But I love that you just brought up deed in lieu of foreclosure, because I just learned a lot about that.
I had a couple of buyers lately who've had issue with deed in lieu and have to wait, through the waiting period, the seasoning requirement there. So, it's interesting in the mortgage business, things tend to happen in cycles. So
Yeah.
you'll get, for me at least, I'll get a lot of people who are talking about deed in lieu of foreclosure that's happened to them previously, and we have to wait. And so educating them they come in spurts. So
Yeah.
it's like, hadn't had one in a long time, and then all of a sudden 3 or 4 pop up, and it's neat to be able to go through that cycle and help them understand. But as you said, think about that. If you're basically deed in lieu of foreclosure, it's in lieu of a foreclosure.
Yeah,
So
we're
you're,
not going to say it's a foreclosure, but here's what happened.
but
You don't have a house anymore.
imagine how stressful that is for
It is.
somebody, so.
Well, the whole thing is stressful.
Absolutely.
Because if you think about it, it doesn't matter if you go through a foreclosure, if you go through a short sale, if you go through anything like that, you're still losing your house. It's still an upheaval, and then obviously you can't just go live on the streets, so you got to figure out someplace else to live and get your life together. So, but for people who may be going through that, and I know this is kind of counter to what our conversations are, because you're trying to get people into houses. For people who could potentially be going through that, it's good to give them the options. Here's what you're actually looking at. These are the steps you need to take, and then I can kick you back over to Rob.
Well, and it's interesting, and I didn't mention it because of this, but the projection and the prediction is that because of COVID, once we get past everything, we're going to see a spike in foreclosures.
Yeah, we
so
are.
it might be a good time for us, maybe in the next video, to talk about deed in lieu of foreclosure or in foreclosures and things like that, to educate people. Because there's a lot of people who are possibly in forbearance right now, mortgage forbearance, that they might get a call from their lender as we get out of this. Hey, you've been in forbearance for 4 to 6 to 8 months.
Right.
We need that payment.
Right.
As we've been talking about from the beginning.
Well, yeah, because I can't go 8 months without you paying. This is not, your house is not free. Like we said last week, that house doesn't belong to me until I get that title. That's mine. Like, until that loan is paid off, that house doesn't belong to me.
Correct.
So there's always going to be somebody coming behind you to say, listen, I'm running a business here too.
Right.
And unfortunately, with what's going on right now, a lot of the states are trying to help with this stuff. So make sure that you're looking into your states or your cities, and for those kinds of grants and stuff. That money did come down from the government. A lot of people don't know about it, but you've got those stalled evictions, and the court systems are all backed up and all that. But yeah, when it comes to a head, it's going to be bad, and we should definitely talk about that.
Yeah, because that those eviction stays have been granted until December, I think it is, by the federal government. So, now you're talking people who, I own a home that I'm renting out. It might be that I'm able to pay my mortgage, but if I can't pay the mortgage because my tenant isn't paying, it's going to cause a lot of problems.
Yeah, it is.
And it's not the tenant's fault a lot of times, because they're out of business. Unemployment's up, and
then they did just lower the unemployment.
Right.
So it went from 600 to 300, I think, was the
amount of money.
Yeah.
So there's a lot of things that are going to happen, and I think it's super important to get that information out. And the funny thing is again, we didn't plan this, but we talked about.
We never planned anything,
Rob.
We
planned debt to income ratio. So
I just want to point out, I sent you a text this morning and said, "What are we talking about?" You said, "Oh."
I don't know. We'll figure it out. You know what? It always turns out to. We turn it into something because we get a lot of questions.
Yeah, we do.
So. If you have a question on something, hey, Ryan's a stud. He's a coach.
Stud!
If you have a question, put it down there. Hey, Jessica, good to see you there. She's here in the building watching us, so that's kind of creepy.
I love your new profile picture. It's gorgeous.
I know, it looks good. She looks awesome. But if you have a question, put it in the comments. Tim Lowry, Tim's definitely a stud.
I know, we talked about this last week. Yes, see, I remember Tim.
Yes.
I did just put that on YouTube last night, talking about Tim Lowry being a stud.
Tim Lowry being a stud. But yeah, if you guys have questions, concerns, you can DM us, you can put it in the comments.
And we talked about this before. A lot of people don't want to talk about the fact that they have financial issues, or their credit might be bad, or something like that. That's okay. It's not something that the public needs to get their hands on.
Correct.
But we are here for those private conversations.
Absolutely.
And let us, because listen, if you're having that problem, someone else is having that same problem. So let us get you through it.
Yeah.
And then let us get other people through it. And we won't mention your name.
Yeah,
so
we won't drop
absolutely drop comments, give us a call, that kind of stuff. Speaking of call.
How can they reach you?
Damn it. Yes. 757-356-5756. I think I got tagged on my Facebook page, SOS Solutions.
Yep, that's tagged.
Look me up on YouTube. Look me up on YouTube.
Yeah, she's crushing it on YouTube, by the way.
I'm having fun with YouTube.
She's a blast over there.
Stephanie Adams on YouTube. That's it. Because I'm the only person in history that uses their actual name on YouTube.
That's alright. That works.
It does. You know who I am. And you, sir, how do we contact you?
Well, you're on my Facebook page or my YouTube page. This goes up there as well. And on YouTube, it's Rob Younce, so he is my name too.
That's true.
You can reach out to me on phone, email, phone or text. It's 757-286-8912. You can email me at rob.y at OVM Financial, robyounce.com.
Come to the building.
Come to OVM,
Yeah.
however.
Yeah.
So anyway.
So I think we got our topic for next week.
We do, so we don't have to
Yes.
do any pre-production planning. This is great.
Yeah, okay. We'll have to get Rob to write it down because I will absolutely forget.
It's going on my calendar, so we're good.
Good.
And if you have any questions or concerns or just in general comments, give us some comments down there. Give us some likes.
Yeah, let us
give us a
know
little bit
what
of
you wanna-
love.
What do you want to know?
We got a lot of, I do get a lot of private feedback that people like our videos, so that's awesome. But we want you to start putting it out in our comments that you like it because it helps us. It helps us get
Yes.
seen.
Spread the word.
Yeah,
Yeah,
exactly.
let
So,
people know.
till next week.
So I don't have to sit here with this dude for. No, I'm just kidding. I'm just messing around. I love Rob.
Until
Younce.
next week, we may not see Stephanie, but thank you for tuning in. Really do appreciate it. You guys are awesome, and look forward to talking to you next Wednesday at 12 o'clock.
12 o'clock.
Giddy up.
Bye, guys.
Bye.